In the Forex market, the concept of margin is crucial for any trader using leverage. While often overlooked, understanding how margin works can make the difference between effective risk management and unnecessary losses. What is margin? Margin is the amount of money you need to deposit in your trading account as collateral to open and maintain a leveraged position. It acts as a security deposit held by the broker while your trade remains open. For instance, if you're trading with 100 leverage, you'll need 1% of the total trade size as margin. If you open a $100,000 trade, you'll only need $1,000 in your account as margin, used margin versus free margin. Your trading account will display two key margin terms, used margin, the portion of your funds that the broker has locked to maintain, your open positions, free margin, the remaining balance available for opening new trades or absorbing adverse market movements. Margin call, the risk of margin. A margin call occurs when the losses from your open positions reduce your free margin to a critical level. At this point, the broker will request additional funds to maintain your trades. If you fail to do so, your positions may be closed automatically to prevent your account from going negative. Margin calculation. The required margin for a trade depends on leverage. Higher leverage requires less margin. For example, with 100 leverage, you'll need 1% of the trade size as margin, while with 150 leverage, you'll need 2%. Trade size. Larger trades require higher margins. Currency pair. Some pairs may have different margin requirements based on volatility and broker policies. Importance of margin in risk management. Avoid over-leveraging. Always keep sufficient free margin to cover unexpected market movements. Monitor your margin regularly. Ensure your trades don't consume all your free margin, especially in volatile markets. Trade with a clear strategy. Use stop-loss orders and set profit targets to protect your account. Conclusion margin is an essential tool in Forex trading, but it can also be a double-edged sword if not used wisely. By understanding how it works and how it relates to leverage and risk, you can trade more safely and effectively.